reasonably pedagogic kind of way, I think. So how I suggest we divide the discussion is that if anything I say is simply unclear, then just ask straight away. But if you have if you have an objection or an elaboration or a comment of some kind, then we perhaps leave that to I've finished talking. The talk will take if nobody asks any questions during it, it will take about 40 minutes. But we have 2 hours, so there is plenty of time for questions and a lot of discussion.
Yeah,
it might be simplest just to log in, wouldn't it? And then, because otherwise they're going to keep prompting you.
Yeah,
And I think most people here have been part of the course, so I'm going to assume a certain familiarity with financial markets and financial terminology. But once again, if I say something that is not familiar, just ask me what I mean. And I assume, therefore, because most of you are part of the course, that you're familiar with automated trading and with high-frequency trading that has the features that I've listed here on the screen. So that if you consider, for example, Virtu, which is one of the world's leading high-frequency trading firms, it trades 500 million shares a day, roughly speaking, and it employs 150 people. So that gives a sense of the small number of people, the huge volume of trading. It takes place in data centers such as these two, and we're going to come back to these two particular data centers towards the end of the talk. And quite often, not always, but quite often, high-frequency trading involves the prediction of price movements. Short-term prediction, a time horizon of typically less than a second, but prediction. And as Emiliano said, that's the core of this talk. It's going to be about how high-frequency trading algorithms do their predictions. And it ought to puzzle us that algorithms can predict prices, because the efficient market hypothesis of financial economics says that you cannot do that, at least not on the basis of public information. And so it's very easy, if you're not an economist, to mock the efficient market hypothesis. Actually, it's not a stupid idea that financial markets are pretty efficient in this kind of sense, that it's very hard to make profitable predictions. So the fact that high-frequency trading algorithms can make profitable predictions is actually a puzzle. It's something that stands in need of explanation. And that's essentially what I'm going to do today, is to talk about how we explain how high-frequency trading algorithms can, despite the efficient market hypothesis, make profitable predictions. So we're going to be talking about pockets of structure within the randomness of price fluctuations. Because if price fluctuations were entirely a random walk, then profitable prediction would not be possible. So the fact that it is possible shows that there is some structure, at least, within that randomness. So that, in a more concrete sense, is what the talk is about. It's about the structure that exists within the randomness of price fluctuations. So here's an example of structure. And in a certain sense, it's the simplest possible example, but it's important nonetheless. I kind of assume that because of the nature of the course, most people will have seen an order book of this kind? Anybody not seen an order book? Anybody need an explanation of an order book? No? Okay, good. So, this is an example here of the pocket of structure that's known as order book pressure. So if you just look at the numbers, you can see there are more offers to sell than there are bids to buy. So supply exceeds demand, so to speak. So it's most likely that prices are going to fall. That's, as it's very, very simple, but it's a very important form of structure. So it makes the question of who or what has access to the order book very important. So if you look back just as recently as, say, 1995, for example, and if you're as old as I am, 1995 doesn't seem any time ago, the New York Stock Exchange had electronic order books of this kind, but access to them was private. Each stock traded on the New York Stock Exchange had a designated trader known as the specialist, who took the central responsibility for trading in that stock, and only the specialist or one of his clerks, and nearly all the specialists were men, which is why I refer to them in the masculine, only the specialist and his clerks could see the order book. So we have a little pocket of structure. You can make money out of order book pressure. A little pocket of structure, but not all traders having access to the data that makes it possible to identify a profitable instance of the pocket of structure. So that makes the question of the prediction of prices a question in political economy. Who has access to the data? Who or what has the capacity profitably to trade using that data? Because again, taking the New York Stock Exchange as an example, an electronic system could send in an order electronically to the New York Stock Exchange, but before that order got added to the order book, a specialist or his clerk had to press enter on a computer keyboard, and they might well delay pressing enter if there was something they themselves were trying to do. So access to the data is a matter of political economy. The capacity to trade is a matter of political economy. And sometimes even the very existence of pockets of predictable structure within the randomness, even the very existence of those pockets is a matter of political economy. And indeed, the pocket of structure that this talk is about, futures lag, is an example. This is a case where the very existence of the pocket of structure is a matter of political economy. And I emphasize material political economy because, of course, this isn't simply a matter of relations among human beings. It's also a question of physical relationships between machines, the connections, the wiring within the data centers within which automated trading takes place. So here actually is a list of pockets of predictive structure. Now, I'm not going to go through all of the list. That will take far too long, so we can come back to the list if you like. But it's just to give you a kind of flavour, because obviously I'm talking about just one pocket of structure, so one of the eight, the second one, futures lag. So this is, because obviously one wants to get a sense of typicality, this is to give you a bit of a sense of how typical futures lag is. So the ones that I put in bold, and then again I'm sure not all of this will be familiar to you, because some of them, for example, number 8 is historical, that no longer exists, so there's no reason you would ever have encountered it. So I'll be talking about this actually a little bit, that 8th one a little bit tomorrow morning. But the ones in bold, you could give the kind of political economic analysis that I'm about to give of futures lag for the ones in bold. So as you can see, they're for roughly half of the instances of profitable structure that I've been able to identify. This kind of analysis can be given. And here, I'm going to elaborate this, but this is the definition of futures lag, that stock index futures prices, and I'm going to talk about what the stock index future is in a moment, stock index future prices typically move a fraction of a second before the prices of the underlying stock. Now, just how big a fraction of a second actually has varied through time. And that means that if an automated system is trading stocks, and here we really are primarily talking about automated systems because that fraction of a second has got too small for human beings to be able to do this. It really does require an automated system. An automated system trading stock can make profitable predictions based on what has just happened in the futures market. Now, I'm a sociologist, and I know most of you are not. Most of you are not. So I will just basically put this slide up, and then it will disappear into the background of the talk. This is the sociological framework with which I'm interpreting the material political economy of price prediction. And really, the only point of any terrific significance, well, it's kind of exemplified by the fact that I've just simply laid those 4 domains out in a horizontal line. I've not arranged them hierarchically. For example, it's a bit tempting to do it hierarchically. In other words, to have trading at the bottom and then politics at the top. But that's not actually quite faithful to how things have happened. The relationship between those 4 different domains is a bit more haphazard than that. There's not really much determinism in it. There's little bits of determinism, but not much. The crucial things are very idiosyncratic. But we can come back to this if anyone's interested, but I know you're mostly not sociologists, and I assume you won't have heard of Andrew Abbott and so on, so we can set this aside for now. Here are the data sources that I'm using to develop the story. Again, we can come back to them. Perhaps I'll just mention the top point and the bottom point. The top point is that for most of the time I've only been able to interview people. There's one case, an early high-frequency trading firm called Automated Trading Desk that I'm going to talk about in detail tomorrow morning, where I have had access to documents as well as to interviews. And then at the very bottom, and I hope you can see his name, he'll appear quite a lot in the story. There is one central person in the story, I'm going to tell you. It's a man called Leo Melamed, who is one of the central figures in the Chicago Futures exchanges. And I've interviewed him twice, but his memoirs are actually also quite a useful source here. So, again, I assume you all know what a future is because of the course that you've been taking. But if you don't, here is a kind of original definition of a future. I say original because this has actually changed through time. Originally, a future was an advanced contract to buy or to sell a physical commodity, above all, grain. Chicago is the center of the futures business of the United States, in a certain sense of the entire world, because Chicago is the center, that's where the rail lines converge, that's where the grain of the great prairies in North America is collected together and bought and sold. And certainly you can buy grain for immediate delivery. But since the middle of the 19th century, you've also been able to enter into futures contracts on grain. In principle, those can always be settled by physical delivery. So you can send your ship or your railway cars to a grain elevator, such as this one, and if they can actually be filled with grain. But actually that's, even in the 19th century, that was quite a rare event. Even in the 19th century, futures contracts were typically settled by cash payments. When the date set in the contract comes up, money passed between via the exchange clearinghouse between the buyer and the seller of the contract. But in principle, they could have settled it by delivering grain. And that started to become important when in the early 1970s, the Chicago Futures Exchanges started to move from the trading of futures on physical commodities such as grain to the trading of financial futures. So Leo Melamed, who I have already mentioned in the first of my two interviews with me, told me about an old trader on the Chicago Mercantile Exchange, a man called Elmer Falker, who said to Melamed, the ultimate contract is a future on the Dow Jones Index, on a future on a widely followed stock index. But the Chicago exchanges couldn't trade futures on stock indices because an index is, of course, a mathematical abstraction. So it's difficult to design a way of settling a future on a stock index by physical delivery of stock, of share certificates. You can just about do it, but it's, at the very best, it's kind of clumsy. So, for example, when the Chicago Board of Trade considered that contract, an index, a future on the Dow Jones Index in 1968, they went and consulted a leading securities lawyer who told them, a man called Milton Cohen, and he told them that they would break the law of Illinois if they traded a future on a stock index. Because in the law of the US, the UK, most European countries where I know the situation, I confess I don't know how Italian law stands in this respect. If a futures contract cannot be settled by physical delivery, then it's a bet, then it's a wager, not a legitimate financial contract. And as you'll know, in most of the United States, gambling is against the law, and it certainly was against the law in Illinois. So the Chicago exchanges would break the law if they traded cash, if they traded a future on an index that could only be settled in cash, that you could not settle by physical delivery. Melamed, though, before he became a trader, had been a lawyer, and he knew that the bans on gambling in the United States were all state law. There was no federal ban on gambling. So this becomes a critical part, the bracketing off of that legal issue that did eventually make stock index futures legal to trade. This is Melamed. The man on the right. This is a man called Tip O'Neill, Irish Catholic from Boston, Democrat, dominant figure in the House of Representatives. And there's something about this picture, the reason it's my favourite is you see the ties are loose, O'Neill holding a cigar. These are two people who know how to do politics with each other. Very different. Say, Tip O'Neill, Catholic, Irish, from Boston. Leo Melamed, Polish, Jewish, from Chicago. But they could speak each other's language. Melamed had a plan. As if he knew that the ban on gambling was a matter of state law, not of federal law, and therefore potentially a federal body could set aside the ban. So here comes one of those haphazard intersections that's very important when one's trying to understand the material political economy of the prediction of prices. It's just possible some of you may have heard of Tip O'Neill. I would be 100% confident that none of you have heard of Bob Hope. He's a forgotten American politician, forgotten even in Texas. And actually, to be honest, rightly forgotten. Pogue is not an... Tip O'Neill was a kind of impressive political figure. Bob Pogue was not. But critically, he was the chair of the House of Representatives Agriculture Committee. So Melamed's plan was to create a new federal regulator for the futures industry and to use that as the vehicle to set aside the ban on gambling. Pogue, as you can see, even Melamed had kind of forgotten him because he couldn't remember how to spell his name. Pogue was fighting a battle of his own. Another, also Democrat in the House of Representatives, a man called Neil Smith, was trespassing on the turf that Pogue considered as the chair of the House Agriculture Committee was to be his. Pogue, there was a struggle going on in politics, and Melamed managed to create a link between that struggle and what he was trying to do in the futures industry. Pogue knew nothing about futures and couldn't care less, but regained his ear. So the necessary change in the law, the 1974 amendments to the Commodity Exchange Act. One of Melamed's allies was Philip McBride Johnson, then the counsel, the lawyer for the Chicago Board of Trade, and Pogue basically let McBride Johnson draft the necessary amendments. It created the new regulator, the Commodity Futures Trading Commission, or CFTC. Being federal law, it preempted state law, and it so laid the ground for the end of the requirement for physical delivery. Laid the ground, but actually didn't achieve it straight away, because during the late 1970s, that was still the Carter administration in the United States, the Democrat. The head of the CFTC was also a Democrat and didn't welcome the end of the classical way of distinguishing between a wager and a legitimate futures contract. So here is something that's a little bit more politically systematic. The election of Ronald Reagan as president. When a new president is elected, the heads of the regulatory bodies in the financial markets in the United States are typically changed, and that happened to the CFTC. Melamad's ally, McBride Johnson, got appointed as chair of the Commodity Futures Trading Commission, and that was what finally enabled the Chicago Mercantile Exchange in April of 1982 to start trading a stock index future, a future on, not in fact on the Dow Jones. There's an interesting story there, but it would take us too long to follow that. A future on the S&P 500 index. That there is a picture of the S&P 500 trading pit of the Chicago Mercantile Exchange from, I think, the early 1990s, just I haven't been able to date the picture. Compared to trading 500 stocks, trading the S&P future on the Chicago Mercantile Exchange offered simplicity. It was straightforward to construct a short position, in other words, a position that would profit if prices fell. When constructing a short position in stocks, it was actually pretty tricky to do, and trying to do it in 500 stocks was very difficult indeed. And it offered greater leverage than in shares. Now, because I know some of you have been trading, albeit mostly with pretend money, not real money, you'll know that for a trader, leverage is everything. If you are confident that you know how prices are going to change, then you don't want to be restricted by your own limited capital. You want to trade using borrowed money. In effect, you want leverage. Leverage in US share trading is restricted by regulation. Leverage in futures is much more generous. To trade futures, all you need is a relatively limited deposit called margin. So there's much more leverage in futures trading than in stock trading. So if you think you know something, and this originated was largely about human beings knowing something, if you think you know something relevant to the value of US shares as a whole, then you're going to want to trade in the Chicago futures market, not in the underlying stock market. So that means, as an economist would put it, that the futures market became the primary price discovery market for US stocks. Overall, new information relevant to the value of US stocks overall first appeared and still appears in the futures market. And only, as I said, a second or fraction of a second later in the underlying stock market. So that, once again, is simply what futures lag means. First in futures, then in stocks. But a product of political economy, as futures lag is, meant and means that it's always vulnerable to changes in political economic circumstances. If the regulation, for example, of shares were ever harmonized with the regulation of futures, then futures lag might well disappear. There's nothing inherent about futures here. If one looked at the relationship between bond futures and bonds, or currency futures and currencies, you don't get that unique directional relationship. So this is very specific to the particular political economy of share trading versus futures trading. So it's always potentially vulnerable, but has never actually succumbed. Probably the greatest danger to futures lag happened way back in 1987, so only 5 years after index futures first started to be traded. The 1987 stock market crash, a precipitous drop, 20% in a single day in the underlying stock market, was blamed on index futures, probably actually a little bit unfairly, but it was blamed on index futures. There was a great deal of pressure to harmonize the two spheres. Melamed and the Chicago Mercantile Exchange. Melamed, as I said, was he's still alive, is a politically savvy operator. He had always put a lot of effort into the Chicago Mercantile Exchange's links in Washington. He would have Congress people and senators come to visit the Chicago Mercantile Exchange, for example, and they would receive honoraria for making this. I mean, not enough to cause them to vote one way or the other. I mean, Melamed had no illusions about this, but he was careful to build those links. One of the first instances of a political action committee, in other words, a private sector committee that gathered money and then directed the money to the election campaigns of senators or representatives. So pressure there was to harmonise the regulation of shares and futures, but it was fought off in 1987, so futures lag survived. It survived, that was an external battle, it survived a truly vicious internal battle in the Chicago Mercantile Exchange, because the S&P 500 future was originally traded not by machines, but by human beings in one of Chicago's famous open outcry trading pits. Melamed was in favour of automation, but faced death threats from fellow traders who did not want their way of life and their way of making money to be swept aside. I love this picture because this comes from the heart of the battle. That's the that's the S&P 500 trading pit in something like 2000. I again don't know the exact date of this picture, and it's a kind of hybrid form at that point. In the foreground, as you can see, are people trading electronically. They're trading something called the ES. Has anybody actually, because I know you've been doing that, has anybody actually traded the ES? Is this at all?
Me.
No.
It's not there.
Yeah. In a certain sense, as we can develop, the ES is the single most important financial contract in the world because it leads just about everything. It leads Europe, for example, as well as share trading in the United States. It's the E stands for E of E mini. It was a fifth the size of what the people in the coloured jackets at the bottom of the bit. This picture is taken from above. It doesn't show the angle very well, but this is a kind of superstructure built around the pit. So the human beings are trading down there, and these are still larger humans operating machines are trading up here, trading the new electronic version of the S&P 500 index future. I saw this actually. I confess when I saw it, I did not know what it was. It took you see, it took a trader from the pit to tell me what was going on in that little glimpse of the history, the automation of Chicago Exchange. It survived the development of ETFs. These are exchange-traded funds. These are shares that, in a kind of way similar to futures, track things like the S&P 500 index. And a pretty neat sort of product if you're a trader. Again, much simpler than trading lots of individual stocks. Very easy to go short in an ETF compared to going short in the underlying stocks. So you remember I had the three advantages of futures over stocks. Two of them get kind of deleted by the introduction of ETFs, which also have those advantages. But still, because an ETF is still a share, the future still gives you greater leverage. So the most famous ETF of them all is something called the SPY, the SPY. That's the exchange-traded fund that tracks the S&P 500 index. It's the most traded share in the world. Traded more than Apple, more than Google, more than Microsoft, more than Facebook. But it's still a share, and it still lags the future. It lags the EX. By 2005, the gap had shrunk down to a tenth of a second in 2005, but because you've been studying automated trading, you know that from the viewpoint of automated trading, a tenth of a second is 100 milliseconds, and that's like eternity. So it's still the case in the United States that futures are regulated by the Commodity Futures Trading Commission, and because of the historic roots of the Chicago exchanges in the trading of agricultural futures, the Commodity Futures Trading Commission reports to the Senate Agriculture Committee. And shares are regulated by the Securities and Exchange Commission that reports to the Senate Banking Committee. And that little, in a sense, quite haphazard, quite idiosyncratic feature of the regulation of the US financial markets is sufficient to keep futures lag in place. The most recent threat to it, but it wasn't, to be honest, much of a threat, was the final act of Barney Frank, representative Massachusetts, the financial reformer. The Dodd-Frank Act is the main post-crisis reform of the US financial markets. He saw this split as the greatest structural weakness of the regulation of financial markets in the US and tried to change it. But no way were the senators and the Senate Agriculture Committee going to allow that, because of course they knew that happened, they would lose the Commodity Futures Trading Commission and the futures, the whole futures area out of their domain. And futures lag runs through the history of high-frequency trading, from its very beginnings, which I'm going to be talking about tomorrow, particularly in this firm, Automated Trading Desk. The prime market indicator that we were using, definitely the key variable. Also, futures lag, very important to, for example, Gecko. Automated Trading Desk was the leading firm in high-frequency trading in the 1990s. Gecko was the leading firm of the 2000s, no longer simply the leading firm, but until about 2010, it was the leading firm. Futures lag, utterly crucial to its history. So from the beginnings to the present. The ES and the SPY is, in a sense, a quintessential high-frequency trade. The fact that two very liquid instruments, but one leads the other by a fraction of a second, and they're traded in different places. This is the data center of the Chicago Mercantile Exchange, which is in Aurora, which is essentially the western suburb of Chicago. This is the NASDAQ data center in Carteret, New Jersey. All the data, there are four main data centers, US share trading, all in northern New Jersey. And the SPY still lags the ES. So now the difference is well below 10 milliseconds. But it's never going to get much below 4 milliseconds. Because we're talking here about a material political economy. Because of course, there's no point in knowing in the abstract that the future price in Chicago predicts the stock price in New Jersey unless you can get that future price from Chicago to New Jersey fast enough. So I haven't placed much emphasis on it now, but the last few slides of my talk will be about the material aspect of the political economy of futures lag, and perhaps above all about the geodesic. I'll ask our physicist, what's the Italian for geodesic, because it's important that
Geodesic.
Okay, so it's, well, I suppose the English is based on the Italian, no doubt, in this instance. So the fastest route, the shortest and fastest route on the surface of the Earth between two places is the geodesic. And the two places are Chicago. Well, this slide, in fact, is not quite accurate because it's really northern New Jersey. That's the crucial place. So how you get the signal from Chicago to northern New Jersey is pivotal to the material implementation of futures lag. What the slide shows, it comes from the website of Spread Networks. And I know Emiliano has told me that quite a few of you have read Michael Lewis's Flash Boys. So this is that wonderful first chapter of Flash Boys, the secret cable, the cable being made in secret from Chicago to northern New Jersey. And the whole rationale of it was to be close to the geodesic. Because railway lines, the easiest place in the United States to lay your fiber optic cable is along railway lines. But of course, railway lines don't follow the geodesic. They skirt round mountains, they divert to population centres, and so on. There was one cable, it had a kind of almost mythic character among Chicago's traders. There was one cable that was actually not too far from the geodesic. It was laid by one of the early internet providers called UUNet, and they did it on the cheap. They just dug it into the soil. They didn't lay it in conduits, and they followed power lines rather than the railroad lines. So this was actually closer to the geodesic than any of the existing and any of the other cables. And a particular Chicago firm, Gecko, I mentioned again, became dominant in the 2000s. And a very important part of their dominance is that they found the UNet cable. But spread networks eliminated that advantage, and Gecko is no longer as dominant, and it's in part because of spread networks. Those of you who let Michael Lewis know the story, 2,000 people working in secret, not being told what it was that they were doing, laying this new, close to the geodesic cable. One of my interviewees told me that one of the difficulties they had was that if you're laying a conventional fibre optic cable, you want lots of slack. Because of course, most of this goes over farmland. Farmers plough, they cut through the cable, so you want lots of slack to make it easy to join the cable back together. And he told me they had great difficulty because the workers who were used to laying fibre optic cables couldn't understand why they were laying a cable with very little slack. And they couldn't be told why, because the whole thing was secret. But of course, again, the physicist here, light in fibre optic cable is slowed by the refractive index of the material. So the spread networks for cable, for example, uses a material called Lucent is the firm, True Wave, RS. Its refractive index is 1.47. So that means essentially that light is slowed to 2/3 of the speed of light in a vacuum. So this is the rationale for the picture I got in the first slide. That's the microwave tower of the New York Stock Exchange in Mahwah, New Jersey, because an electromagnetic signal passing through the atmosphere is it's marginally slowed by comparison with the speed of light in a vacuum. The effect is very small. So microwave is faster, but it doesn't free you from the constraint of the geodesic, because of course you want the fastest microwave, you have to be close to the geodesic. And the trouble with microwave is the signals can interfere with each other. So you want, if you're a microwave engineer, these are the various frequencies that are available for microwave. This is regulated by the Federal Communications Commission. These are the various frequencies that are available. You want to be using 6 gigahertz because that gives you the greatest reliability. But you can't use just 6 gigahertz if you want to be close to the geodesic, because it's a crowded geodesic. There are too many 6 gigahertz dishes already. So you have to, the Tish is one of the few interviewees who's allowed me to name him. This is a man called Stefan Tish, who is the co-head of a firm called McKay Brothers, is a leading supplier of microwave links. So they use not just 6 gigahertz, but 11, 18, even sometimes 23 gigahertz. But that makes your microwave link vulnerable to something as simple as rain. So as Tish told me, there's a saying that he's heard, when it rains, spreads are wider, no, differences in prices are wider in New Jersey. It is also some significance that the geodesic clips Lake Michigan and also Lake Erie, and some of the, depending on what precise route you're following, sometimes that's as much as 120 kilometers, which is quite a big difference from the viewpoint of microwave transmission. So some of the links are vulnerable to even something as benign as the summer sunrise over the Great Lakes, because of course the sun heats the upper atmosphere more faster than the lower atmosphere, and the refractive index of the atmosphere is affected by temperature. So you lose the line of sight between your microwave towers sometimes when this effect sets in. But, as you can see from the table, the industry is getting closer to the relativistic limit. If Einstein is correct, then no signal on the surface of the Earth is ever going to get from Aurora, where futures are traded, to, for example, Carteret, one of the 4 main share trading data centers, in less than 3.93 milliseconds. So my most recent interview on that topic reported that they were down to 4.01, so getting closer. So just to recap, that's the story that I've told you so far, and the stuff in grey is what I'm going to talk about tomorrow morning.
Thank you, Don. We have a little break, and then
Yeah,
we
of
start
course.
the debate.
Yes.
Okay. Dopo 15 minuti. 15 minuti di pausa.
As you see, you know, I do actually read a lot of physics.
Yeah.
It's correctly pointed out relevant. Because you have to wire the transmit signals, so it becomes relevant at this level. Yeah, you cannot do any better than 3 point.
Yeah.
So we have to move closer, perhaps.
But that is politically impossible.
Yeah.
Because it's Chicago, it's Illinois.
Yeah.
You know, if you try to move futures trading, I mean, obviously they make perfect logical sense.
Yeah.
Move futures trading to New Jersey.
Yes.
Yeah.
Politically, that would be explosive.
Would it?
Yeah. Yeah. You know, imagine senators from Illinois.
Yeah.
We must defend our.
Yeah. Yeah, because look, just 2 weeks ago I was in Sweden. In Sweden, futures and stocks are traded in the same data center.
So.
Yeah.
No,
So then it is literally just
Yeah.
an issue of wiring within the data center.
Yeah, sure.
So non leg.
Well, there is still a lag actually.
Okay.
Yeah.
But,
Tiny.
Tiny. Yes.
yeah.
Right. Oh, we are.
We're
Recording.
Yeah.